Hello everybody, welcome to the Like Totas channel. Happy Thursday. And today's video is going to be about analyzing businesses in no longer than 15 minutes. Yes, you heard that right, 15 minutes. If you are a busy professional, this video is definitely for you because I was a busy professional at one point. I still am. And the reality is that there are so many misconceptions when it comes to analyzing stocks. One of them is that it requires tremendous amounts of time to determine whether a company is good or not. But in this video, I want to demystify that conception because it's wrong. And I will show you why. Okay, so stick with me till the end of the video because I do believe this is going to be very insightful. In addition, it's going to be jam-packed with actionable tips. So make sure you smash the like button if you find this video cool. All right, so the first thing that I want to address here is that there are so many investment strategies out there. Not every single one of them allows you to actually analyze a business within 15 minutes. And I want to be clear here. Uh, Understanding a company very, very well, of course, will take you much longer than 15 minutes. But what we want to determine right off the bat is whether the company is worth further research or not. And this framework, so this checklist, allows you to quickly filter out your universe of potential investments and determine whether they are worth, whether the remaining companies are worth further research or not. Okay, and that's exactly what we are planning to do. First off, let me start by showing you this right here. And you can see that this channel is about we want to build strategy. We want to use a strategy, and you already know what the strategy is. We want to select high quality companies, not at reasonable prices. So we are not a quality investor type per se. But what we really want is the best of both worlds. We want highest quality at the lowest possible price. And there are many strategies that will allow you to outperform the benchmark, and by that I mean the S&P 500 over time. And you can see that right here in these charts. This chart compares index returns for factors over the last 20 years, and you can see that over the past 20 years, several strategies actually outperform the S&P. And quality investing, by the way, you can see the S&P quality index is the one that has outperformed the most. Okay, which is cool because a lot of what we teach and practice is built on the idea of quality investing. We just like quality with a big margin of safety. I have no idea why I'm using this, so I'm going to take this off. Okay, much better. So let me minimize this and let's keep this video short and sweet. And I always, I put everything together in a PDF that I'm sharing with our community members and clients. But you can make notes along the way. This is how I personally analyze a company in 15 minutes. This will help you. Most investors, as I already alluded to, think stock analysis needs hours of spreadsheets, endless news, and complex models. The reality is that you don't need to know everything. You need a repeatable filtering process that helps you quickly separate great businesses from mediocre ones. And by the way, how many of us have fallen into the trap of doing so much research and then we end up not pulling the trigger? That is paralysis. I think it's a bias action paralysis, something like that. I think it's how it's called. So we really want to simplify things, not oversimplifying them, but certainly making them simple can definitely help us achieve our goals. This is exactly what the 4M framework is designed to do. This 4M framework consists of meaning, mode, management, margin of safety. Guys, you will need this forever. If you are following this channel, then that's because I believe that strategy that I teach here really resonates with you. That's awesome because everything that I do is predicated on these 4 elements right here: meaning, mode, management, and margin of safety. And in 15 minutes, I can usually tell whether a company deserves deeper research or should be ignored. Why this matters? Because our time is limited. Yes, oh my God. I'm an investor. I run an investment coaching business. I have to create content. So can you imagine like going just doing like just analyzing companies? To me, in my world, it wouldn't be efficient. Now, look, I love analyzing companies, and I really pour a lot of time into going through annual reports, quarterly reports. I'm passionate about that. That's how I do a lot of my reading. But the reality is that I have to juggle different commitments, and my time is limited. So the goal of a first review is not to build a perfect valuation model, but to answer one question: is it worth studying further? If the answer is no, you move on quickly. Step number one: make notes. This should take about 1 to 3 minutes. You start with the business itself. If you don't understand how the company makes money, then how on earth are you even considering investing in that company, right? So it's if you don't understand how the company makes money, you don't understand the business. You don't understand the business model. And if you don't understand the business model, I promise you, you will panic at the first sign of volatility. And I've seen this happening countless times. I was guilty of that as well. It happened to me, and it will continue to happen. So, what we want to be able to explain the business in simple terms. As Peter Lynch said, it should. If you can't explain the company in 10 minutes, to like to attend to if you can't explain how the company makes money in 10 minutes, then it's an easy pass. And there are other questions that I want to ask as well. I don't see many people making these questions. So I think, but these have helped me over the last few years, and I promise you they will help you because they force you to think as a business owner. Make note: what does the company sell? Who pays for its products? Why are the customers buying it instead of buying something from competitors? And then, most importantly, am I genuinely interested in the company? Even if you understand how they make money, if you are not interested in learning about the company, you're going to have a very hard time. Uh, you're going to have a very hard time staying up to date with the relevant metrics over time. Okay, so if you could, would you buy the company outright today? That is the core question that you have to ask. If the industry is growing or declining, is demand likely to still exist in 10 years? Rule: if the business is too complex, unclear, or outside my circle of competence, I just skip it. There are thousands of listed companies. You don't need to force ideas. Keep it simple, short and simple. Step two: moat. You have determined that you like the company, that it meets your criteria for meaning. Now you want to know whether the company has a durable competitive advantage. I may love pizzas. I may love, for example, Domino's pizzas, but if the business does not have a competitive advantage, I'm not investing in it. All right. A great business is not just growing today, it's protected from competitors tomorrow. What I look for: you have to determine what are the competitive advantages of the business. Do they have like a brand reputation, network effects? Typically, a business with a strong moat will have a combination of different moats as well. So, for example, take Meta, former Facebook, as an example. They have a large network of users that creates network effects, right? Yeah, but they also have intangible assets, a lot of intellectual property. Everybody knows Meta and Facebook, so they have brand reputation. They have scale advantages as well. Okay, the stronger the moat, the more likely it is that there is a combination of different moats. You have to determine what makes the company unique. Then, if when you determine the moat, you have to ask: is this moat being backed by strong numbers? And I look at 3, 5, and 10-year track records. Look for consistent progress in revenues, earnings per share, operating cash flow growth, and book value per share growth. Why only these five? Why only these four? Because typically wide moat businesses over time will show consistency in the numbers across 3, 5, and 10 years. They will show you at like 10% or beyond over these time frames. Let me take a zip here. Okay, so I use the 10% as a useful benchmark. However, make note, though quality matters more than any single number, and sometimes you will still see a company, right, that doesn't meet that hasn't grown revenues at 10%, but has grown revenues at 8 or 7%, and that is still a fabulous business. So there are some nuances here, but by default, this is what you should be doing, especially if you are just getting started, because it will really narrow down your universe further. Profitability. Look for margins at 40% or above. Net margin, ideally 10% or above, because higher margins often signal pricing power, efficiencies, and a stronger moat. Okay, margins are a percentage of revenue. So the more a company can convert revenues into profits, the better. Balance sheet strength. If the company has a lot of debt relative to free cash flows or earnings, to me that can signal a red flag. I skip those companies immediately. I like companies that can pay down all of their debt within 3 years of free cash flows or earnings. You can use that. Strong businesses should not rely excessively on debt. Step number 3, management. You should take this should take between that should be between 9 and your 12 minutes. Even a great business can be damaged by poor leadership. What am I looking for in specifically? I'm looking for capital efficiencies, and that will be shown in the form of ROIs over time and also ROI. Why? Because if the management does a great job at allocating capital, in other words, at converting capital at converting invested capital into profits, that will show in ROIs, and you will see a ROIs of 10% or above over 3, 5, or 10 years. A poor management team cannot achieve that. So if you see those numbers, in all likelihood, you are trusting your money with management teams that have your best interests at heart. Qualitative factors, that is even better. You can look for skin in the game. If management has a lot of the wealth tied to the company, that is fantastic. It makes our interests align. In addition, the CEO might be new to the role, but has he or her been with the company for a long time? I would love to see that, because I like team management teams that have been with the company for a very long time, because they know the company inside out. Okay, shareholder friendly behavior. Also, look for transparency and integrity. That is what I want. These are some of the questions I ask right here. Step number 4, last one, margin of safety. The business can meet your meaning, your management, and your mode criteria, but it may not be trading at a reasonable valuation level. In fact, it may not be trading with a margin of safety. And more often than not, this is exactly what happens. And so they just stay on the watch list, and you set the price target against that. A wonderful business can be a poor investment if you overpay. Price matters, ladies and gentlemen. Quick valuation checks, PE ratios, price to free cash flow. In other words, how much are you getting? How much are you paying relative to how much is the business giving you in earnings and free cash flows? You can compare the ratios against the industry. So imagine the software industry trading at the PE of 35, and then there is a software company that trades with a PE of 15. That can be a sign of undervaluation. In addition, you look for the company's own 10-year average. If the 10-year average is 30 and the company's current PE is 15, there can be a sign of undervaluation as well. Make sure it's not a value trap, though. You want to confirm that all the other M's are checked, namely moat in this case. Okay? Now, here is the thing. You don't need to do all of this manually. There are stock screeners, and that is what allows you to input relevant parameters that then you run the search for, and that gives you a universe that matches certain quality criteria, and you just need to check then the meaning in what exactly the mode is. But one of the fastest way to find candidates is by using a stock screener. You can filter for all these things that I discussed: revenue growth, high margins, low debt, strong ROIs, attractive valuation as well. It helps narrow thousands of stocks into a manageable shortlist. Many of the people that I coach actually were not even familiarized with stock screeners before they starting working with me. So that's why I'm conveying this to you as well. Final reminder: this 15-minute process is not about making instant buy decisions, it's about filtering efficiently. Most companies will fail one of the four tests. That's it. And that is a very good thing, because ultimately what you want is to have a watch list of, say, 30, 40 companies, because that will translate into a portfolio of 10, 15 companies over time. So this is the 4M summary, and I cannot stress how important this is, everyone. So if you find this video insightful, please let me know, because that would make me more prone to continuing to create more value for you over time. Also, let me know if you have any ideas for future videos. I would love to see that in the comments. I hope this helps you, because it certainly helped me. Thank you so much, everyone. Enjoy.